In this video, we're going to talk about the Sharpe ratio, which is a key ratio in investing. So first, let's talk about portfolio returns. And it's pretty common to hear a portfolio manager describe their funds in terms of the return in the fund. 15% per annum sounds great. 10% per annum does not sound as good relative to 15%. So you'll often see this information as kind of a primary piece of information when somebody talks about their fund. Now, the first problem with this as a measurement of the fund, of how successful a fund is without context, it's impossible to know whether 10 or 15% is a good return. So, for example, if you could invest in a risk-free asset or relatively risk-free asset such as a US Treasury bill and earn 16%, then neither return is great, right? As you can earn more without taking risk. And just as a reference point, 3-month Treasury bills paid 16.3% in May of 1981. So it's not a totally crazy return. And so if I could earn 16.3 by investing in Treasury bills, or somebody told me I could earn 10 by investing in some, let's say, stock market fund, I'd rather 16.3 in Treasury bills, even though, again, it's a 3-month. These are annualized returns. So over 3 months, you earn about 4%. So first, instead of talking about return, we might want to talk about the excess return, as in the return of the investment over a risk-free investment. If it's positive, then at least one's making more than risk-free. And if it's negative, then this is probably not an investment worth thinking about. The other thing is risk. So the next challenge in terms of just thinking in terms of return is that the excess return as a performance measure is you don't know how likely it is that it will be repeated. Remember, we're always looking on a forward basis, and so we've got an expected excess return as opposed to the historical excess return. So we have an expected return on an investment or an expected excess return on investment. And if the investment is very volatile, then it might not be very valuable, right? If it's an expected excess return of 15%, oops, sorry, not an excess return. If the excess return, let's say, is 5%, but the investment's very volatile, then we might be willing to take, say, a 3% excess return with less volatility. The Sharpe ratio is defined as the return or expected return on a portfolio minus the return on a risk-free investment divided by the standard deviation of that portfolio return. Now, this can be used as a backward-looking measure where the return on the portfolio and the return on risk-free are both historical measures, or it could be looked on a forward basis, right? What's going to happen? What do we expect to happen into the future? So let's look at a portfolio whose expected return is 8%, the return on a risk-free investment is 4%, and the standard deviation of the portfolio returns is 20%. So the Sharpe ratio is 8% minus 4% divided by 20%, or 0.2. Now, if two portfolios have the same excess return, remember excess return is portfolio return minus risk-free return. If two portfolios have the same excess return, then the one with the lower standard deviation will have a higher Sharpe ratio, and that portfolio should be a better investment. If two portfolios have the same standard deviation, then the one with a higher excess return will have the higher Sharpe ratio. That portfolio should be a better investment. Now there's a danger here. The Sharpe ratio is not perfect. It assumes, certainly, that standard deviation is a good measure of risk. And if standard deviation is not a good measure of risk, then this ratio doesn't mean a lot. And it is possible to construct investments with very high Sharpe ratios that are incredibly dangerous. For example, selling options can be a very profitable strategy. The standard deviation of such a strategy can be very low until a catastrophic loss occurs. In my derivatives class, we consider such an investment. We actually look for an investment which has a phenomenal Sharpe ratio, where basically standard deviation of returns is 0 until it's not. Right? So the standard deviation of returns is 0, but there's a probability, very small, that on any given time period, let's say it's a week that these investments happen, on any given time period, there's a very small probability that you're going to lose all your money that you've ever made and more. Now that doesn't show up in the Sharpe ratio because the standard deviation returns, you're always making money. So the standard deviation returns is basically zero until one day you wake up and you're bankrupt. So Sharpe ratio isn't perfect, but it's a reasonable measure. It's a reasonable starting point for measuring risk. Okay, so we want to maximize a Sharpe ratio, right? If we have a portfolio of 2 stocks, just like we minimized the variance of that portfolio, we can maximize the Sharpe ratio. Now, it's a little bit harder because the formula is a little bit more complex. So maximizing Sharpe ratio isn't quite as easy in terms of calculus to do compared to minimizing variance. But we're going to go through and I'm going to show you how to use Excel for this problem. So we have 2 stocks. The expected return for the first stock is 6%, and the expected return for the second stock is 8%. Standard deviation of the first stock's return is 20%. Standard deviation of the second stock's return is 15%. And you believe the correlation between the stock's returns is negative 20%. Okay, so let's go put this into Excel and let's take a look at what's going on. We are going to put our data into our Excel spreadsheet. So let's get some headings in here. So we've got an expected return for the first stock, an expected return, can't spell, return for the second stock, and that was 6% and 8%. We've got a standard deviation for the first stock and a standard deviation for the second stock, and that was 20% and 15%. And we've got a correlation between the stocks of negative 20%. And finally, we have a risk-free return of 5%. And notice, of course, the 5% is less than the 6 and the 8. So these are all inputs into my problem, so I'm going to format them appropriately. There we go. And these are all headings, so I'll format that appropriately. There we go. And a little bit wider. There we go. Okay, so that's my data for this problem. Now, if we're going to construct a portfolio which maximizes the Sharpe ratio, we need to construct the portfolio. So we're going to have 2 weights, weight 1 and weight 2. Weight 2 will be 1 minus weight 1, and weight 1 will be an input, and weight 2 is going to be a calculation. So let's say right now, not 50, but 50% of the first stock, and we'll format this as a percentage as well. Okay, so we've got weight 1 and weight 2 of the 2 stocks, which we've just chosen at random right now, and we'll figure out how to make those the correct numbers in just a minute. Okay, so we've got our 2 weights. Now, in order to calculate the Sharpe ratio, we need the expected return of our portfolio, and we need the standard deviation of our portfolio. So, expected portfolio return, can't spell. Make this a little wider again. Well, that's weight 1 times return 1 plus weight 2 times return 2. So that's our expected portfolio return. We don't absolutely need to see this, so we'll call that a calculation. Let's do expected portfolio variance, and then I'll do the standard deviation as the square root of that. That'll be just a little easier. So square root of the previous cell. These again are going to be calculations. Expected portfolio variance is weight 1 squared times standard deviation 1 squared, because that's the variance, plus weight 2 squared times standard deviation 2 squared, plus 2 times weight 1 times weight 2 times the covariance, and the covariance is standard deviation 1 times standard deviation 2 times correlation. So Expected portfolio variance, 0.01263. Portfolio standard deviation, this should be a percentage, 11.24. Okay, so now we have enough tools, I should probably shrink this a little bit so we can see everything on the screen, to calculate our Sharpe ratio. So the Sharpe ratio for this portfolio, and this is our output, of course. So the Sharpe ratio for this portfolio is excess return. So that's the portfolio return minus the risk-free return divided by the standard deviation of the portfolio. And it's typically going to be written as a number, 0.18. So that is our Sharpe ratio. Okay, now what we're trying to do is maximize the Sharpe ratio. Find the portfolio with the maximum Sharpe ratio, and that's balancing excess return against standard deviations. Higher return means higher standard deviations generally. And of course, with portfolios, though, sometimes that doesn't have to be the case, right? We can generate two portfolios which have the same return. One has a high standard deviation, one has a lower standard deviation. So it's not quite right, but basically we would expect generally that a higher return implies a higher standard deviation. The Sharpe ratio tries to balance these two ideas. So we're going to go Data and click on Solver. Now this should be installed. If you haven't installed it, you need to follow the instructions on the Canvas page to install it. So we're going to go to Solver. And we're going to set the objective. And our objective is to take this, which is our Sharpe ratio, B15, cell B15, and we want to make it as big as possible by changing the weights. So we're going to try to find the weights such that the Sharpe ratio is as big as possible. Now, I'm going to turn off this make unconstrained variables non-negative. So the unconstrained variable in this particular problem is weight 1. Allowing it to be negative means that we could short the stocks if we so chose in this portfolio. We could have a negative weight. Negative weight means that we short the stock. We borrow the stock, we sell the stock, which gives us more money. We take that money and we buy the second stock. So let's click Solve. It comes back, it's converged to a solution. All the constraints are satisfied. We can either go back to where we started or keep the solution. So we'll say OK. And we'll see here in this particular setup, with these expected returns, 6 and 8%, these standard deviations, 20 and 15. Now these standard deviations are a little weird in that the stock, we'll call these stocks for a second, the stock with an expected return of 6% has actually a higher standard deviation than the stock with an expected return of 8%, but okay. This tells you don't buy a lot of the first stock. Buy 25% of your portfolio of the first stock, 75% of the second, and that maximizes the Sharpe ratio. So this is how we go through and maximize the Sharpe ratio. Is now we are not using calculus, but we're using Excel Solver. As it turns out, you could actually use calculus for this problem. The derivative is a little more challenging. Finding when when you take the derivative, you set it equal to 0. Finding when it's 0 is a little more challenging, but you can do it. And if you're very, very careful about it, you will end up with the 24.3